for today include understand the concepts of taxable income from business, recognize the tax treatment of trade, business income, or income from other source. 3. Distinguish between income receipts and capital gains. Before we go deeper into the topic, it is good to note that corporate tax is a very wide area that includes many complex concepts and calculations. It is not only the computation of the corporate income tax of an entity, it entails understanding into collection mechanisms such as withholding tax, as well as the arm's length basis concept of transfer pricing. In the next two webinars, I hope I will be able to share more on the select focus areas on corporate tax to support your learning as well as the upcoming examination. Overview of Singapore tax system, which is our corporate tax system. In order to understand Singapore corporate tax system better, one need to first look at the governing legislation. In Singapore, the applicable tax legislation is the Income Tax Act. What I would say to be the most basic section of the Singapore Income Tax Act is known as Section 10 of the Singapore Income Tax Act, or commonly known as the charging section. Section 10.1 states that income tax shall, subject to the provision of this act, be payable at the rate or rates specified hereinafter for each of the year of assessment. So, before I proceed further, for those who are not familiar with the Singapore law and legislation, you can note that the Singapore Income Tax Act, as well as the other legislations, can be found on the Singapore government website. Therefore, for those of you who are interested to read the actual income tax provision, please feel free to Google the Singapore income tax legislation available and the AGC website. Now, under Section 10.1, there is a need to understand the scope of taxability. Broadly, income that falls into these three main categories are considered taxable in Singapore for corporate. 1. Income that's accrued in or derived from Singapore, commonly known as source in Singapore. As an example, a Singapore company running a business operation in Singapore deriving an income would constitute income derived in Singapore. Next, corporates also are expected to pay tax on certain income received in Singapore from outside of Singapore. The way to understand this link is foreign income remitted to Singapore. For example, Singapore company may maintain an offshore bank account for trade or other valid commercial reasons. A very common one would be for a Singapore company to maintain an offshore USD bank account either in the US or in Hong Kong as the Asia's financial hub for their foreign exchange needs. The account there and the deposits may accrue interest that they will gain from the bank, for example, HSBC, may pay them interest based on the daily balance of the deposit in those bank accounts. For this income, it's only taxable when it's remitted into Singapore. Last but not least, in respect of, also known as in-scope income that can be subject to tax. For this category, we'll be looking at income in respect of Singapore, such as the sales of goods or transaction with a Singapore-based individual. Now, we will further deep dive into accruing in or derived from Singapore, also known as sourced in Singapore. As a general rule, the taxability of an income is such that unless the income is specifically exempt from tax in Singapore, a person who receives the income from various sources under Section 10(1), namely Section 10(1)A to 10(1)G of the Income Tax Act, is accessible to tax on the income it receives. Ordinarily, if the income is Singapore source, the income will be taxed when it's either accrued or booked in. However, if the income is considered foreign source passive income, it will only be taxable if it's either received or deemed remitted in Singapore. So, fixed place of operation. We have talked a bit about a Singapore company deriving an income source in Singapore. So, how do we understand this in adherence to the Income Tax Act? Here, we would like to introduce the concept called fixed place of operations. By default, all income earned by a Singapore resident company or Singapore incorporated in company will be considered sourced in Singapore unless they are earned through a fixed place of operation outside of Singapore. Now, this concept of fixed place of operation is not defined in the respective Income Tax Act. There are many factors to consider, include permanency and control of this fixed place of operation. Now, I understand that for those of you who are based outside of Singapore, this may be an abstract understanding. So, how I would actually liken it to a real-life practical example. Ordinarily, if you are a Singapore company, this is where you will have a registered business address. That will be by default your fixed place of operation in Singapore. Now, certain Singapore companies have developed themselves and grown beyond the Singapore market. It is not common, rather, it is not uncommon because Singapore is a small country with a very limited market size. Therefore, for companies to continue to grow beyond the saturation, they need to expand into the regional market. This is where this fixed place of operation concept comes in. Companies could, in today's world, depending on their type of offerings, operate either through a fixed place in Singapore to sell to their customers outside of Singapore, or establish a fixed place of operation outside of Singapore to cater to the customers. For example, today, the use of social media is prevalent. A seller running a business in Singapore could be selling goods through Facebook, through TikTok, Douyin, to end users in other countries in the region, such as Vietnam, China. If they maintain their place of operation in Singapore, they consider it to be Singapore source income. However, if they are able to explain to the Inland Revenue that for the sales they have made to the individuals, let's say based in Vietnam, is supported by a fixed place of operation in Vietnam, where they do have staff, goods, as well as other operations, then it will be considered foreign source to a place of or fixed place of operation outside of Singapore, in this case, Vietnam. One thing you have to appreciate is because this is not defined in the Income Tax Act, the burden of proof is on the company to demonstrate that the income they have earned is related to a fixed place of operation outside of Singapore if they are treating that income as not sourced in Singapore. Here is another example. Singapore Company A sends a staff to Company B in country B for a project that lasts for a week. During the project, the staff uses Company B's office, stay in a hotel, and the staff return to Singapore after completing the project. The income from the project that Company A earns, in this case, is considered sourced in Singapore. This is because the income is not considered to be earned through a fixed place of operation in country B. In fact, the office that the staff uses is not controlled by Company A, and the usage is only temporary. Compare and contrast this to my earlier example where I mentioned that the sales made through an online channel such as Facebook, TikTok, or Douyin is then fulfilled by operations in that particular country where there is staff, there is perhaps warehousing operations, or where the stocks are. All these are factors of permanency. And based on the fact pattern, as compared to this example, that fact pattern may be a stronger support in support of the fact that the income is not sourced in Singapore. Here comes a very fundamental question that you may have been asking yourself as you go through this webinar. Why is it so important to determine if the income is sourced in Singapore? This is because for the Singapore company, if the income is sourced or deemed sourced in Singapore, it would be taxed in Singapore based on the accounting year basis. However, if it's not deemed to be related or attributed to a fixed place of operation in Singapore, it would mean that it's not sourced in Singapore, and therefore it would be foreign source income and not taxed in Singapore unless it is remitted or deemed remitted in Singapore. Therefore, whether an income is sourced in Singapore has a direct impact on the taxability of that particular stream of income in Singapore. Next, we move on to understanding the concept of trading in versus trading with. The following was extracted from Section 10(1) of the Singapore Income Tax Act, which sets out the territorial basis of taxation in Singapore. It reads, income tax shall, subject to the provisions of this Act, be payable at the rate or rates specified hereinafter for each year of assessment upon the income of any person accrued in or derived from Singapore or received in Singapore from outside of Singapore in respect of. Distilling this down in the layman language, basically, it sets out the basis of taxation of an income of a Singapore tax resident. Generally, around the world, there are 2 to 3 types of taxation basis. The first type of taxation basis is what we call global taxation basis. Countries that adopt a global taxation basis would tax its resident on its worldwide income, regardless of where it is derived from. Countries that adopt such a basis the most prominent one would be US, because US corporations as well as individuals are taxed on their worldwide income in the US. On the other extreme end, we have the territorial basis, where only income that is derived or accrued from the country itself is taxable. So on that front, we have Hong Kong as an example, which clearly only tax Hong Kong sourced income, and there are many exemptions even for passive income. On the middle ground, we have a country similar to Singapore, where what we call the quasi-territorial regime, where Singapore would tax both either income that's accrued in or derived from Singapore or foreign income remitted into Singapore. So clearly, Singapore takes a wider than average tax net, but however, still want to maintain some kind of framework that does not pool the global income of a tax resident to tax in Singapore. This becomes a very important aspect for a foreign company, because if a foreign company's trading profits will only be taxable in Singapore if it is trading in Singapore, as these profits are considered sourced in Singapore. However, if the foreign entity is found to be trading with Singapore, then its trading profits are considered sourced outside of Singapore and not taxed in Singapore. The deemed source provision under the Singapore Income Tax Act can be found under Section 12, which covers a wide range of scenarios and situations which an income could be deemed to be sourced in Singapore. Now, let's look at a simplified method to understand trading in and trading with Singapore. If a foreign entity uses Singapore as its base to sell its goods to individuals in Singapore, this is a situation where the profits will be considered as taxable as it is trading in Singapore. However, if the foreign entity is simply trading with Singapore, i.e., it uses a fixed place of operation outside of Singapore but sells it to its customer in Singapore, either through direct shipment or through courier and logistic, then we should consider the entity as trading with Singapore, and its trading profits are considered sourced outside of Singapore. Next, we will take a look at the deemed source provision. Section 12.1. So, Section 12.1 states where a non-resident person carries on a trade or business of which only part of the operations is carried on in Singapore, the gains or profits of the trade or business shall be deemed to be derived from Singapore to the extent to which such gains or profits are not directly attributable to the part of operations carried on outside of Singapore. Digesting this section, what it meant is that when a non-resident person, such as a foreign company, only carries on a limited operations within Singapore, the portion of the gain or profit that shall be taxable in Singapore, because of the fact it's deemed derived, should be the portion that is not directly attributable to the part that's outside of Singapore, meaning it's on a residual basis. So, for example, if 90% of your operations are done from outside of Singapore, and you do have a base in Singapore, and there's 10% that you're unable to directly attributable to outside of Singapore, the 10% balance of the operations will be attributable or deemed derived from Singapore. So the question that a lot of companies will ask themselves is, how do I avoid this? Because the company does not want to be in a situation where it's a foreign company with a foreign fixed place of operations, yet found to have operations carried on in Singapore. So many companies either ensuring that they do not have any operations on the ground or directly handle all outside of Singapore, and therefore they will avoid triggering this deemed provision due to the fact that they have part of the operation carried on in Singapore. Just to be clear, part of the operation carried on in Singapore does not include a situation where they just appoint a third-party logistics service provider like DHL shipping the goods from outside of Singapore into Singapore. So it would have to be a situation that they have either a retail store or staff taking order, arranging delivery in Singapore. That's where you will have part of our operations carried on in Singapore itself. To better understand, let us go through an example in greater details. Company A engaged Company B in country B to provide consultancy services. The services are partly conducted in country B and partly in Singapore. The total fee charge is 10,000, of which 7,000 is attributable to the fee services rendered in country B and 3,000 is attributable to the services rendered in Singapore. Therefore, the 3,000 will be considered to be deemed sourced in Singapore and subject to tax in Singapore itself. Next, we move on to Section 12.6. Section 12.6 covers any interest, commission, fee, or any other payment in connection with any loan, indebtedness, or with any arrangement, management, guarantee, or service relating to any loan or indebtedness, borne directly or indirectly by a person resident in Singapore or a PE in Singapore, except in respect of any business carried on outside of Singapore through a PE outside Singapore or any immovable property situated outside Singapore, or deductible against any income accrued in or derived from Singapore, covers any income derived from loans where the funds provided by such loans are brought into or used in Singapore. So what does this whole 12.6 mean? It sets out the scenario for which payment that's called interest, commission, fee, or any name that's connected with a loan or any kind of indebtedness like a bond, right, would be paid by a person resident in Singapore or deductible against its income in Singapore or covers any income derived from loans where the funds are brought into Singapore. Meaning if the interest is on loan where the loan amount is used in Singapore or brought into Singapore, it will be triggered, deemed in Singapore. For example, Company A took a loan from Company B in country B and pays interest to Company B. The loan is used in Singapore for Company A business in Singapore. Therefore, the loan paid is deemed sourced in Singapore. So if we look at the earlier requirements, which rule have we triggered? The rule that's triggered is the fact that the loan that Company A took from Company B, despite the fact that it's taken in country B, is used for Company A's business in Singapore. Therefore, it will be deemed sourced in Singapore, and the moment that it's deemed sourced in Singapore, withholding tax would apply. So, Section 12.6 also governs an exemption, also commonly known as Section 12.6 capital A. It provides exemptions for payment for services associated with any arrangement, management, or service relating to any loan or indebtedness and any guarantee relating to loan or indebtedness. One thing I would like you to note here is that the exemption covers payment for services. There is no exemption covering interest. Therefore, for interest, as long as the conditions are triggered, it will be deemed sourced in Singapore. So, for example, Company A engaged a bank in country B to arrange for a loan for a fee. The arrangement is performed in country B and the bank has no presence in Singapore. The service fee paid is not sourced in Singapore, even if the loan is used here. This is because under the exemption itself, as long as the service fee associated with the loan is performed outside of Singapore and not associated with any of the permanent establishment in Singapore, is not sourced in Singapore. Now, let's look at Section 12.7a and 12.7b. Section 12.7a and 12.7b covers royalties, know-how, show-how, and management fee and rent of immovable property in Singapore, borne directly or indirectly by a person resident in Singapore or a PE in Singapore, except in respect of any business carried on outside of Singapore through a PE outside of Singapore, or deductible against any income accrued in or derived from Singapore. In a simplified manner, this section means that for payments related to royalties, know-how, show-how, which can be broadly classified as technical service fees or even like franchise fee, management fee, and rent of immovable property in Singapore, it will be deemed sourced in Singapore if it's paid by a person tax resident in Singapore or is deductible against any income accrued in or derived from Singapore. So we also look at Section 12.7c and 12.7d. 12.7c covers management fees where the domestic withholding rate is 17%, and 12.7d covers rent for movable properties, so such as car rental, excavator rental, those are movable properties, and the domestic withholding tax rate under the Singapore law is 15%. Permanent establishment. So, the permanent establishment definition is covered under Section 2 of the Singapore Income Tax Act. Here, we'll look at what are the various listed components of the permanent establishment covered by Section 2 of the Singapore Income Tax Act. Permanent establishment means a fixed place where a business is wholly or partly carried on, including a place of management, a branch, an office, a factory, a warehouse, a workshop, a farm or plantation, a mine, oil well, quarry, or other place of extraction of natural resources, a building or work site or construction, installation, or assembly project. So what needs to come to mind here is what's the importance of establishing a permanent establishment in Singapore? So permanent establishment under the tax concept is the concept of a taxable presence. So when a foreign company is found to have a permanent establishment, it means that the foreign entity has a fixed place where the business is wholly or partly carried on, and therefore will be subject to tax on its income because its income would then be considered derived from Singapore. So from A to I are some of the exhaustive examples of what constitute a fixed place for which a permanent establishment would arise. In addition, you may also generally understand that it could be analyzed in three areas. One, a fixed place of business that's set up in Singapore. Two, supervision activities carried on in Singapore. Three, represented through an agent in Singapore. So, for example, what is a fixed place of business set up in Singapore? Company B from country B set up a branch in Singapore. it uses a rental office to provide its services to customers in Singapore. In this situation, even though company B is a foreign company, by virtue of the fact that there is a branch as well as a rented office, there is a permanent establishment, or rather, company B has set up a fixed place of business in Singapore for which it will then derive Singapore source income and is required to pay tax on it. Now, here's an example of supervision activities carried on in Singapore. Company B in country B sent one of its staff to Singapore to carry on supervisory activities of a construction project in Singapore for 3 months. It is there under this situation, there is actually a permanent establishment in Singapore created by the staff sent to Singapore to carry out supervisory activities of a construction project for more than 90 days. Next, received in Singapore from outside of Singapore, also known as remitted to Singapore. This is governed under Section 1025, the deemed remittance concept. So under Section 1025, it is hereby declared that for the avoidance of doubt that the amount described in the following paragraphs shall be income received in Singapore from outside Singapore, whether or not the source from which the income is derived has ceased. A. Any amount from any income derived from outside Singapore which is remitted to, transmitted, or brought into Singapore. Any amount from any income derived from outside Singapore which is applied in or towards the satisfaction of any debt incurred with respect to a trade or business carried on in Singapore. And C. Any amount from any income derived from outside Singapore which is applied to purchase any movable property which is brought into Singapore. So, how do we understand this deemed provision? For deemed remittance, the understanding should start from source of income. So earlier we mentioned that Singapore has a quasi-territorial tax regime where it taxes income accrued in and derived from Singapore as well as income remitted into Singapore. There are many ways of remittance. The easiest way to understand remittance is, of course, when the company brings in the money from outside of Singapore into Singapore. However, Section 1025 provides 3 scenarios for which you could have a remittance whether or not the income itself is physically brought into Singapore. Let's apply some examples to the 3 areas here. 1. Any amount from any income derived from outside Singapore which is remitted to, transmitted, or brought into Singapore. Let's say a Singapore company has a bank account in Hong Kong and earns interest of $1,000. At the end of the year, it transferred the $1,000 from the Hong Kong bank account to a DBS bank account in Singapore. It will trigger A, because the interest is remitted into Singapore. B, instead of transferring that 1,000 to Singapore, the company who is running operations in Singapore made purchase from a Hong Kong vendor with respect to the Singapore business. Instead of bringing the $1,000 interest back into Singapore, it uses the interest to pay the Hong Kong vendor. As a result, it will be considered deemed remitted, triggering Rule B, because the income is used or applied towards satisfaction of any debt incurred in respect of a trade or business carried on in Singapore. Or the company decide to use $1,000 to buy a famous Chinese painting and bring the painting physically into Singapore. It would then also be deemed remitted into Singapore under the third arm, which means that income derived from outside of Singapore applied to purchase any movable property which is brought into Singapore. In this case, the $10,000 interest income is used to purchase a Chinese painting from China, and that painting is brought into Singapore. So here are some examples. Company A earned interest income from a bank deposit in country A. Interest income remitted to the Singapore bank account via bank transfer. Interest income is deemed remitted. Similar to what we just explained earlier, clear cut. Second example, Company A earned interest income from a deposit in country A. Country A bought an equipment in country A using the interest income and brought the equipment to Singapore. Interest income used is also deemed remitted, similar to my third example of a Chinese painting, right? Because we have a situation where the foreign interest income is used to buy an equipment, which is a movable property, and the movable property is moved physically into Singapore. Next, in respect of in-scope income that can be subject to tax. So section 10(1)(a). 10(1)(a) relates to gains or profits from any trade, business, profession, or vocation for whatever period of time such trade, business, profession, or vocation may have been carried on or exercised. To determine whether or not you are carrying on a trade, what we usually do is we apply the 6 badges of trade under the common law concept. Now, taking a step back, it is important for us to understand why are we so focused on the concept of revenue, or rather, gains or profits from any trade. This is because Singapore tax regime only tax revenue gains. Any capital gains is not subject to tax in Singapore. However, if we refer to the Singapore Income Tax Act, you will not be able to find any definition of what constitutes a capital gains. Therefore, it leads many to wonder, given that the definition doesn't exist, how do one differentiate what is capital versus revenue in nature? This is where common law developed concepts such as the 6 badges of trade is widely adopted by the Inland Revenue Authority of Singapore in order to establish whether or not such gains will be considered to be revenue or capital in nature. In the next slide, I'm going to bring you through what are the 6 badges and some practical examples to talk about them. 6 badges of trade. As you can see, each badges of trade are associated with a very old common UK law case. This is because the 6 badges of trade is created under the UK common law, where back in the days that UK courts have to establish what would constitute a case of revenue versus capital gains type of cases. The first batch of trade is called subject matter. In the case of Routledge versus IRC 14 TC 490, the taxpayer purchased 1 million rolls of toilet paper, which were subsequently sold at a profit. Even though this was the only transaction, he was held to be trading and the profits were taxable. So applying this concept the judge derived in this case itself, it appears that the court is convinced that the subject matter, which is 1 million rolls of toilet paper, could not be reasonably understood to be purchased for long-term storage or usage, and even though it's one single transaction in terms of the purchase, it was held to be trading, because what other purpose do you have to store 1 million roll of toilet paper other than to sell it off for profit? Next, length of period of ownership. In the case of Wisdom versus Chamberlain 45 TC 92, silver ingots were bought and sold within a year. The profits were held to be trading profits and were taxable. So this is a more subjective aspect or factor, I would say, because what is long enough is subjective and hard to define. But in general, the length of period of ownership factor plays in. The longer you own a property or asset or the subject matter before you dispose of it, there is a higher chance that it's considered to be a capital gain when sold and not revenue gain. This is because the general idea or concept is if you are trading, you're expected to turn it around within a shorter period of time to keep making a profit. Whereas, arguably, if you have bought something with the original intention to hold it for long term, but ultimately sold it due to your change in circumstances, the longer you hold it, such as 5 to 10 years, it's harder for those profits to be argued as revenue in nature, as there will be hardly businesses who will make profit from transactions that will be held once every 5 years. So, this is something that you will have to consider when evaluating the length of period of ownership. Next, frequency of the number of similar transactions by the same person. So in the case of Pickford versus Quirk 13 TC251, the taxpayer was a member of a syndicate that bought and sold cotton spinning mills. The syndicate bought mill owning companies, liquidated them, sold their asset as a profit. The profits from the sale were held to be trading profits and therefore taxable. So what's unique in this case is the subject matter itself is not ordinarily something that you would think is actually revenue in nature. They're talking about cotton spinning mills. So, for example, property. So you would think that when people buy and sell property, it will be generally be a capital asset and any gains is capital in nature. What would, however, be a differentiating factor would be a property trading or developing company that sells property as a business. In this case, it's clear that the court found this syndicate that keep buying new owning companies and sold their asset as a profit. So because of the frequency and the number of similar transactions undertaken by the same particular person, they were held to contribute to a factor that's revenue in nature. So it's like the taxpayer, had they done one sale, it's unlikely they're going to be ruled as revenue. But when they sold the 100 cotton spinning mills, by then it's harder for them to argue that these gains are capital in nature. Next, supplementary work on or in connection with the property realized. In the case of Kate Brandy Syndicate versus IRC 12TC358, the taxpayers purchased a quantity of brandy and blended with another. It was then recast and sold. The profits were held to be trading profits and therefore taxable. So the concept in this case derived is that if you've done supplementary work on or in connection with the property realized, then there is a stronger indication that you intend for it to resell with a profit. It will be no different from a property developer buying a rundown, fallen looking house, renovate it, and flip it for a tidy sum of profit. In this case, it's very difficult for the property developer to argue that it's selling a capital asset as it has undertaken supplementary work on or in connection with the subject matter to increase the intrinsic value of the subject matter. Next, motive. In CIR versus Fraser 24TC498, an isolated purchase and resale of whiskey in a Wonder Warehouse was held as trade, as the intention or motive for the purchase was to make a profit. So in this case itself, it is pretty arbitrary, and I would say that in real life cases, motive could be very hard to prove. So, for example, if there's a single case of transaction of an individual buying a house and quickly sold, then does it by itself cause the trade to be revenue in nature? Then one has to look at what's the motive of the individual acquiring the property. And, and contemporaneous evidence that speculates or set out the motive is usually hard to find. So, practically, what we have seen would be companies who are making such an investment would draft up board resolution, the document contemporaneously the motive of them entering into acquisition of land and building, hopefully to provide an evidence to support their assertion of the motive at the time that they would like to make the investment. Next, circumstances responsible for realization. In the case of Hudson's Bay Coal Limited versus Stevens 5 TC 424, the taxpayer gave up its charter in return for a large quantity of land. The land was subsequently sold and the gains were not held to be trading profits due to the circumstances surrounding the disposal of the property. So the concept or factor that the court has taken into consideration is if you have to realize or sell the subject matter due to external circumstances beyond your control, then it is very unlikely for them to find the factor to be revenue in nature. Because for a revenue gain, you are willing to part with the subject matter for a tidy sum of profit, with the motive to make the profit in the first place. So, using a practical example, if a company bought or invested in a property for capital gains with the intention to hold it, however, due to the unexpected turmoil in the global geopolitical segment, leading to a significant increase in interest rate, and the property was no longer deemed viable for the company to hold due to the hike in the monthly repayment amount, and end up having to sell the property or to realize the sales, any gains could be arguably to be capital in nature, provided that the company is able to prove that the short term ownership was due to circumstances beyond its control and it has no intent to resell in the short period, but for the unexpected circumstances that put it in the current position. Now, one thing that the candidates have to be clear about the six badges of trade is there is no literature to support which factors will be more important over the other. Neither are the courts able to conclude which singular factor will be one that will overwhelmingly push the case over in evaluating capital versus revenue in nature. These six factors are usually reviewed in tandem and done in a holistic manner to ensure that the courts are able to understand the whole circumspect of the transaction and conclude accordingly. Therefore, when applying the six values of trade to determine a nature of a gain, one will need to consider all the six factors holistically and come to a conclusion on the nature of the gains itself. Next, dividend. Dividends are a distribution of a company's profit to its shareholders. Dividends are sourced in Singapore if the company making the distribution is resident in Singapore. Since January 2003, under the new one-tier corporate tax system, tax will only be imposed at the corporate level and all dividends distribution by a Singapore tax resident company under the one-tier system to its shareholders, both Singapore and non-Singapore tax residents will be exempt from Singapore tax. What it meant here is dividend coming from a Singapore incorporated company is always tax exempt in the hands of its shareholders, regardless of whether the shareholder is a Singapore tax resident or not. Therefore, for corporate income tax purposes, we will only evaluate the taxability of foreign dividend received by the Singapore corporation. So please take note that during the exam, if you see any dividend from a Singapore incorporated company, please disregard that for Singapore income tax purposes, as dividend is exempt from tax in the hands of its shareholders. For example, Company A received dividends of 1 million from Company S. The dividend of 1 million received is exempted from tax. For those of you who are based outside of Singapore, you may note that this is not true in most of the countries in the region. So in countries like China or Vietnam, dividend from local companies are subject to tax in their country respectively. Next, 10.1f, rents. So 10.1f describes that rent from movable property is actually taxable in the hands of the company who owns or derive the rental income. Correspondingly, expenses incurred in getting the tenant can be deducted in getting new tenants, and expenses of a capital in nature are not deductible. Only repairs, replacements, and renewables are allowed. Further, no capital allowance will be given, while group assessment can be elected. Under the law, the landlord of residential property may adopt the use of 15% of gross rental income expenses, excluding mortgage interest, as a proxy if the landlord is unable to trace the expense. What that means is, during the computation of taxable rental income, you may choose to deduct certain expenses such as repair, replacements, and renewal related fees. However, as an administrative concession, where landlords have often expressed the difficulty to inland revenue of tracking such expenses, they may elect for another approach, which is to assume that 15% of their gross rental income constitute deductible expense. So they are only taxed on the balance of 85% of their gross rental income. This approach is accepted by IRAS. For the purpose of the exam, please take note of the exam question requirements. The exam questions historically have questions that says that the landlord, or rather the company in question, would like to elect for the 15% gross rental income ex expense method, while there are questions during the years which they would like to elect for the itemized method, where they will claim all the expenses allowable. Whether which method will give rise to a better outcome is fact dependent. Therefore, you have to read the question carefully. If the question does not prescribe which approach required, please also take note that if the question states that they would like to maximize the deduction or minimize their tax, then you have to evaluate and identify the method that will give rise to the lowest tax payable for the landlord. Next, 10.1f, royalties. So essentially, what are royalties? Royalties are payment received for the use or right to use of something, such as patent or trademark. Accessible income refers to gross royalty less any attributable expense. So Section 10.1.4 covers that if an author or composer or company in which is the sole owner, the tax accessible of the royalties would be the lower of 10% of gross royalty amount or net royalty income, where this gross royalty minus of related deductible expenses. The tax concession does not apply to royalties or payment received for any work published in any newspaper or periodical. No, it also no longer applies to approved intellectual property or approved innovation from year of assessment 2017 onwards. So generally for 10(1)(f), you have to understand that the income that's assessable is basically gross royalty less any expenses. Revenue versus capital receipts. So other than the 6 badges of trade which we have talked about, we have also covered the fact that there are 2 possible types of receipts for either revenue or capital. Clearly, Singapore only tax capital gains, and therefore revenue gains are not considered taxable. One way to understand whether an asset is capital or revenue is what we call the tree versus fruit concept. So an asset is capital in nature if income is produced from it. Therefore, the asset is basically the capital, and if you're selling the asset, any gains is capital in nature. And if you sell the income or you derive the income generated from it, it's revenue. For example, a house is capital in nature, which is considered to be a tree, and the rental income from letting out the house is the revenue portion, which is the fruit. So therefore, if you are making a gain from sale of a house, it should be capital in nature, and of course the rental would therefore be revenue in nature and taxable. Take note that this cannot be overly generalized, and you should also consider the 6 badges of trade when you look at the very specific nature of each income and gain. Okay, next, when one is to sell the house, i.e. the tree, receipt received is generally considered capital and not taxable. And of course, income of the fruit derived from the exploitation of the house, such as rental, is classified as revenue received and taxable. Another example here, Company A bought a system to manufacture goods for sale. The receipt from the sale of goods are revenue in nature. The receipt from the sale of the system, however, is capital in nature. So this is very common where a company like a semiconductor manufacturer will purchase high-class top-end equipment, right, for manufacturing of silicon chip. After 2 years or after the project is finished, they may sell those equipment as it may no longer be needed for another client. However, as the assets have been fully depreciated, the company may make a gain from the sale of the equipment. So we should treat the gain as capital in nature because those are manufacturing equipment, in this case the tree, that's used to manufacture the silicons, which in this case is the fruit. And the sale of the silicon chip manufactured would therefore be considered revenue in nature. The other way of understanding this is the fixed versus circulating capital. So capital here means a sum of money, and fixed capital used in the business to produce income, and any receipt from the sales of the fixed capital is capital receipt. Examples of fixed capital are plant and machinery. Circulating capital arises from assets which are continuously being circulated in the ordinary course of business. So in this case, what I would say your raw materials. So again, likening to the fruit and tree concept, the idea here is to understand that any sale of fixed item, or rather capital item, should result in capital gains as opposed to revenue items, which will ordinarily result in revenue gains. Now, income exempted from tax. Although Section 10 defines the type of income that's subjected to tax in Singapore, Section 13 to 13Y states explicitly some of the income that exempted from tax. In the case where there is a conflict between 10 and 13, Section 13 will prevail. In short, the income will not be taxed even though it falls within the ambit of Section 10. Now, the way I see this and how I think it should be explained is that Section 10 is the general charging provision which sets up the scope of taxation, provides for which type of income is considered taxable income. However, Section 13 steps in to further provide for exemption against Section 10. So, the right way to read the legislation will be first understanding the taxable scope of the receipt and then check if Section 13 will exempt it. A good example will be Singapore dividend from a Singapore company. Section 10 provides that dividend is considered revenue taxable to the corporation. However, Section 13 exempt Singapore dividend from being taxed in the hand of the shareholder. Therefore, even though dividend itself could be a taxable income for the shareholders or the Singapore taxpayer, it is exempt from tax by virtue of Section 13. Here we'll look at two very common Section 13 exemptions that you will likely to come across in the course of your study and your future work life. Section 13A. Foreign source income in the form of dividend, branch profit, or service fee provided through a fixed place of operation in a foreign company to any person not being individual resident in Singapore shall be exempt from Singapore income tax subject to conditions under Section 13(9). This means that foreign source dividend, branch profit, or service fees provided through a fixed place of operations outside of Singapore when remitted to Singapore could be exempt if we satisfy the conditions under Section 13(9). So what are the conditions under Section 13(9)? Section 39 conditions are 1. Headline tax rate of the foreign country from which the income is remitted is at least 15%. 2. Foreign income has been subject to tax in the foreign country from which it was received. 3. Comptroller is satisfied the tax exemption will be beneficial to persons resident in Singapore. So, if these three conditions are met, Section 38 would be triggered and the foreign source income is exempt from tax in Singapore. Here, you have to understand that the headline tax rate of the foreign country that which the income is remitted refers to the highest corporate tax rate of the country. So this is critical because in most Asia Pacific countries, this condition is definitely achievable. In APAC, the lowest corporate tax rate would be in Hong Kong, where it stands at 16.5%, to the highest being in India, after taking into account various local and state as well as national level income tax. So you do not need to evaluate the exact rate of the income is being subject to in the country. It must come from a country that's a headline tax rate of at least 15%. Therefore, most APAC countries, if not all, would have satisfied this requirement. Foreign income that's been subject to tax in the country, this is a more tricky requirement, and in some countries may be harder to prove. But if we are talking about country with withholding tax on remittance, then it will be easier as the withholding tax will also be a form of tax that you can prove that income has been subject to. And the last condition is the controller is satisfied that exemption will be beneficial to the Singapore company. In this case, it's usually I would say, exit provision because certain Singapore companies who are subsidiaries of a global MNC may not want the exemption as they may have to then pay a higher tax in their home country. An example will be a US national. Say a US national having a Singapore subsidiary may not consider the tax exemption as beneficial as they will have to pay tax on this same stream of income in the US, which tax on worldwide income. In this case, if they can write into the inland revenue and have the controller satisfied that the tax exemption is not beneficial to them, they could have those foreign source income subject to tax instead. So with that, I think we would like to walk through what we have done today through an example. Company A received a dividend of 1 million from Company B in country B. The corporate tax rate in country B is 25%, and company B paid tax on the profit in which the dividend was declared from. Question: does the dividend satisfy Section 39 requirements? The answer is yes, because Section 39 states that the dividend must come from a country with a headline tax rate of at least 15%. In this case, satisfied as is 25%. And two, the dividend must come from income that has been subject to tax. Question states company B paid tax on the profit, and there is no fact pattern here to suggest that the exemption is not beneficial to the Singapore company. Therefore, the dividend of 1 million received by company A in Singapore should be exempted from tax under Section 13(8). Foreign source income. Foreign source income remitted by an individual is exempt from tax. Foreign source income remitted by a person other than individual is taxable at the point of remittance. I think with that, I would like to round up today's session. For the first part of corporate tax, we have established an overview of the Singapore corporate taxation system, where we understand the quasi-territorial system of Singapore corporate taxation, income which are subject to tax in Singapore, the various kind of deemed remittance rules and requirements, as well as covering specific exemption under Section